current bank appetite?
Mainstream banks have had appetites that's waxed and waned over the year. As of October 2025, there does seem to be more activity from the mainstream banks, and they do seem to be more aggressive in lending. That is obviously a good thing for businesses, and they can access that finance. However, they are still slow at decision making. So the earlier you start with the bank in your process, the more likely you are to be successful and get the money at the time that you need to get it.
What about debt funds and private credit?
Debt funds work on an internal rate of return model. So an IRR model effectively looks at how much money have you got for the money that you've spent. Unlike banks, which work on a fractional reserve basis, so they do not have to have a pound for every pound that they lend out, debt funds do have to have a pound for every pound that they lend out. That means that they're generally looking for around a 15 to 20% IRR. What does that correlate with? It generally means they want to double the money that they've put out. Now, if they lend you £5 million, they would like £5 million back in terms of fees and interest and exit fees and so on and so forth. So that's something to bear in mind. In terms of those private credits, more and more of them are becoming available, particularly at the larger end of the market. The typical cycle that a debt fund might follow is when they raise their first fund, they might deploy £1 to £10 million checks. Then they go out and raise a bigger fund, and therefore they start to move up the curve. That does then leave a gap behind for businesses that are looking to raise at the smaller end of that spectrum. And then we tend to go through cycles in that space. So private credit does become, depending on the time of the cycle, very easy to access or harder to access for businesses. You should speak to an advisor to help you figure out where you're at in the cycle and which funds are most appropriate for what you need.
How is AI affecting the fundraising market?
Particularly for early stage investments, AI is now over 50% of investments that are going into that market. So it is definitely an area of investment that investors are excited about. That does make it harder to access capital for funders that are not, for businesses that are not in the AI space. That's something that means that effectively those businesses are finding their normal routes to capital blocked or perhaps being deployed elsewhere in the market. So even if you have not got an AI business, you are being affected by AI in some format. That does mean that there is a gap in the market for funders that specialise in non-AI opportunities. And it also means that in order to access those funds, you might need to speak to an advisor that has a good breadth of knowledge and access across the fundraising market.
What can non-AI businesses do to attract attention?
In the lower mid-market, a lot of businesses do not prepare for processes to raise finance or sell their business. So if you go with a well-prepared set of financials, a good board pack, and a set of KPIs that you've got good tracking against, that will make you stand out against other businesses trying to raise in the sector. Where access to capital is more restricted, being able to stand out is critical. How do you prepare that material if you haven't done it historically? You should speak to someone that specialises in business readiness. We've got a sister company called K3 Advantage that does some business readiness work, and you should have a chat with someone like that who's able to help you prepare those board packs, prepare your business for sale, with a view to getting ready for a sale in 3, 6, 12 months time. The sooner you start that process, the easier it will be for you to stand out against other people in the space.